In our strategy, we use a five-phase macro framework. We do not predict tops or crashes. We sequence risk based on probabilities and system signals. Markets look calm on the surface, but one long-term ratio is sitting at a historic pressure point, and when this signal moves, recessions often follow. We are reviewing analysis from Into the Cryptoverse by Benjamin Cowan. The focus is stocks priced relative to gold. Our job is to translate that signal into our strategy process. This chart compares the stock market against gold. It measures relative trust, not absolute price. It shows where capital prefers claims versus hard assets. This ratio falls when confidence shifts. That happens because liquidity tightens. And when liquidity tightens, risk assets usually struggle. Direction. The ratio is flat to rolling over. Magnitude. Past breaks aligned with major drawdowns. Relationship, gold strength often comes before equity stress. This is happening because capital is seeking durability, and when that happens, speculative assets lose support. That is why this chart matters now. This ratio stalled before the Great Depression. It broke down again in the 1970s, and it rolled over ahead of the financial crisis. Unemployment is rising without mass layoffs. That means hiring is freezing. Hiring freezes usually come before layoffs. New workers feel it first, then earnings expectations weaken, then equity risk increases. Markets can rise with narrow leadership. That creates the illusion of strength. But narrow breadth makes the system fragile. Many expect gold weakness to boost stocks. History often shows the opposite. Stress can pressure both at the same time. This raises recession probability. It increases downside sensitivity in equities. It shortens the timeline for confirmation. Quick disclaimer. This is educational macro analysis only. It is not financial advice. This does not guarantee a crash. It does not rule out rallies. Policy can still delay outcomes. Printing can stabilize markets temporarily, but each intervention reduces future flexibility. Delay is not the same as resolution. This is why high multiple equities become fragile. This is why gold holds value during stress. This is why cash regains optionality. This signal fits late Phase 1 behavior. Pressure is building toward Phase 2. Forced liquidation is not confirmed yet. We watch monthly closes on this ratio. We track labor and liquidity together. We preserve optionality for later phases. Stocks versus gold measures trust. When trust leaves stocks, recessions often follow. That is the core takeaway. We do not need to be early. We just cannot afford to be late.